Everyone, we're going to give about 30 seconds for anyone else to pop on real quick, and then we're going to go ahead and get started today. So for those of you that are on, did everyone jump on our recording, our first recording for the non-QM Mastery Series? This is number 2 out of 3. If you guys want to use the chat box, let us know if you attended the previous one or if this is the first one you're attending. We will put a link in this call session, and I believe when we send this out as well via email, we could link the first call as well. So that's a really good question. Thank you. First one for you. Okay, cool. All right, well, we'll make sure you guys get the first recording so that you guys have the full series. All right. Attended previously. Christian, good job.
Happy to have you guys back.
Yeah. All right, so I'm going to go ahead and get this party started. So just a recap. So in our first session, we introduced why behind non-QM, why it matters, why it's growing, and what you can't afford to, you can't afford to ignore it. And we also provided some insight on who to target with your marketing efforts. So again, for anybody just hopping on, we'll go ahead and provide the link for our first recording of the series and get that on over to you. My name is Suzanne Samid. I am our production support supervisor here at Sierra Pacific. I also do some of our training, so I'll be here to help you guys today along with Will and John, who I will introduce in just a moment. So now it's time to talk about the what and the how. So in this training, non-QM Navigator is all about equipping you with a clear understanding of our products themselves and how to position them with confidence. So from bank statement loans to DSCR, 1099 income, full doc, asset depletion, and more, each solution opens the door to a borrower who you might otherwise have to turn away. We don't want that. Every loan counts. So you'll walk away with a firm grasp on what makes non-QM different, how to match borrower profiles with the right non-QM products, real life use cases, and talking points to win that trust, and most importantly, referrals. And then this is where strategy meets execution. So the more fluent you become in these loan types, the more value you bring to your borrowers, your referral partners, and your own bottom line. So let's jump in and map out the non-QM landscape together. I'm going to go ahead and introduce Will Davis over on the 1s and 2s. So Will is our VP of non-QM strategic growth, and he is our professional that's going to walk us through. I will monitor the chat, and then I did want to give you guys a heads up that after each section within the presentation, there's going to be a little Q&A. So I'll be sure to capture all of that and then share that with you guys as well. All right, Will, it's all yours.
Thank you, Suzanne. Yeah, so again, mouthful of a title there, but I'm just basically here in short to help you guys grow, both in how to market, how to capture the business, and then how to turn that into closed deals and funding. So let's go ahead and kick it off and talk about some products, the specificity of what we can do and what we can't do within non-QM. So quick overview, what is non-QM? How is it different? In simple terms, it's just an alternative ability to repay, especially if you're utilizing these alt-doc programs. So, in lieu of tax returns and all of those traditional means of, sourcing income, maybe a W-2, something of that nature, pulling those tax transcripts. Within the alt-doc space, we have the ability to utilize bank statements or a P&L that's prepared by a CPA or similar. Maybe using cash flow from an investment property like a DSCR loan. So there's a lot of different ways that we can, kind of pivot into these products. And basically, the short-term answer is to generate additional income that wouldn't have necessarily been available if we had gone those traditional routes. It also helps us circumvent, if we're going like a full doc or a wage earner, it helps us circumvent some of the limitations that are set forth by, QM, whether that's conventional guidelines or Govy guidelines. So it's a way to kind of work around those. And of course, these are all manual underwrites, so no findings to dictate, what we can and cannot do on the file. Non-QM is not subprime lending, so if you have that in your headspace, get it out. We're completing an ability to repay, maybe in an alternative way, but we are completing one. We're fully verifying documentation, income, all of those sorts of things. So if you think it's subprime, it is not. So here's a quick glimpse at our borrowers. We talked a little bit about this in our previous presentation as we were kind of going over who to market to, and kind of reference some of these things, but just to go over it again, bank statements, we're really looking at self-employed borrowers here, typically savvy business-centric individuals, oftentimes really great borrowers because they understand the use of credit, and they also understand the importance of obtaining a mortgage loan so they can keep the majority of their funds either in their businesses, right, as an investment, or in the market, maybe as an alternative type of investment. 1099, this is perfect for, kind of what we've, come to quote as the gig economy. A lot of individuals out there, and employers too, are choosing to utilize gig workers. These could be, contractors or, people that are doing some sort of, side jobs. Maybe it's their primary source of employment as well. A lot of different options there. DSCR, we're really looking at real estate investors, typically individuals that are trying to build some sort of generational wealth to pass on to their subsequent generations through real estate investment. That's really what we're looking at there. Asset depletion, oftentimes high net worth individuals, maybe a twilight borrower that has kind of concluded their work in the workforce and has, some funds that we could then utilize as a source of income, whether standalone or supplemental. And then full doc or wage earner. Obviously these are going to be wage earners or self-employed borrowers. Most often, if we're utilizing the full doc or the wage earner product, we're really just trying to circumvent some of the limitations or restrictions that are set forth within those conventional or Govy guidelines. So just kind of keep that in mind. So bank statements, we're looking at 12 or 24 months bank statements. You can do personal or business accounts. You also have the option with certain products to use commingled accounts. By commingled accounts, I mean their business income and their personal resources for, making payments and buying things, those sorts of things are all housed in one account. So we have options to utilize any of those options. Whether that's, again, personal, business, or, a commingled account even. We do require a business narrative for all of our self-employed products, bank statements included. The business narrative really just tells us kind of the script of how their business operates, how it earns its income, in what ways. It can also really help us alleviate or prevent some additional conditions that might come in. You could explain things like, hey, they do trade shows and a lot of their transactions are through Zelle or PayPal, right? Which we might consider cash transactions, or maybe they are truly cash transactions that they do at these trade shows or similar. That's kind of a perfect example of how that business narrative can explain the income, explain how it's earned, why the deposits are the way that they are on those bank statements. And then it can do a couple things for us. Not only eliminate conditions to explain that later, but it can also eliminate conditions for sourcing of those deposits and that income, because we know, hey, this is how they earn the income. It's consistent across all their bank statements. Here we go. We have a very clear picture of how they earn their income, what their business model is, their employees, all of those sorts of things. It can really just help kind of clear that up right out of the gate for your underwriters. We do allow up to 3 separate business accounts to be used, as long as each of those businesses, kind of in the next bullet point here, they have to own at least 25% of any business that we utilize for the income. So we can utilize up to 3 separate business accounts. However, for those of you that maybe have someone in mind or that you've encountered in the past that has, maybe they're a serial entrepreneur or restaurateur that owns multiple businesses, right? Maybe 6, 7, 8 of them. We could still utilize all of those businesses that they own 25% or more ownership percentage of. However, what we would do in that case is do 12 or 24 months personal bank statements and then supplement with 3 months of business bank statements for each of those businesses we're going to utilize, just to track that source of funds back to that business account. Income can be supplemented in a number of ways on these bank statement transactions, and this is going to kind of run through for anything we talk about today other than DSCR. So we can supplement in a lot of different ways. You could do alimony, child support, trust income, royalties, maybe disbursements. All of those sorts of things are all different ways. Rental income, there's a lot of different ways that we could supplement or bolster the income along with utilizing this alternative documentation like bank statements, 1099s, et cetera. We do have default expense factors from 15 to 85%. They do vary on products. So we have one that uses a grid that is 15 to 85%. As you can see in the graphic here, it's based off of a service or product business and then the number of employees. Service businesses obviously have less overhead. They typically don't have like a brick and mortar location. They don't have a lot of, overhead in terms of, maybe just depending on the number of employees, as you can see in the right-hand side of the graphic. So in those businesses or those instances where they don't have a lot of overhead, they don't have inventory that they're carrying, they don't have machines that are making the products, those sorts of things, obviously that's going to have a lighter expense factor to it. So we have, starting at a floor of 15% if you're a service business with no employees. And then if you had 5+ employees in the service business, 50%. But then moving on to the product business, obviously you may have, a brick and mortar location, you may have machines, a lot of employees to work those machines, HR on site, all of those sorts of things. You're going to have a significantly greater number of employees potentially, and then you're also going to have the overhead of that location, those machines, everything to operate and produce that tangible product, including inventory and things that you're going to have and space for and all of those sorts of things. So you're going to start at 25 if you had no additional employees and move up to 85 if you had greater than 5. If for some reason you had someone that kind of fell into this bucket where they were hitting, that 50% or even 85% expense factor, don't worry, we have you covered. We have 2 additional products that have a default 50% expense factor, and they don't utilize this grid. So if for some reason you had someone that was in a product business and had greater than 5 employees, I would recommend pivot over to one of our other products that you default to the 50%. And just by doing that, you're getting 35% more of the eligible deposits that are showing on their bank statements. Keep in mind, we do also take a haircut for their percentage of ownership. So let's just say you had $100,000 in eligible deposits and you had a 50% expense factor, but you only own 50% of the business. So not only are you going to haircut that 100,000 by 50% for your expense factor, but you're also going to haircut it again by another 50% for your percentage of ownership, which would only give you $25,000 to then divide over the 12-month period. With that, an important note on the expense factors here, we do have the option to provide a CP&A prepared P&L, third party, of course, can't be self-prepared. If you provide that P&L, depending on what it shows on that P&L, we could lower or mitigate your expense factor down to a floor of 15% on the product that utilizes this grid. Our other 2 that default to 50%, you could modify that all the way down to a 10%, which means you could have eligible deposits up to 90% counted for their total income, assuming they own 100% of the company. Now we'll answer a couple of quick questions here for you.
Yes. So, Will, can you use one borrower that is self-employed to qualify with bank statements and another borrower to qualify using their W-2 wage income?
Absolutely. Yes. So if you had, maybe the primary borrower or even a co-borrower that was using bank statements in order to qualify, utilizing the alt doc enhancement within the non-QM products, you could absolutely utilize the W-2 income from a co-borrower. With that being said, it's important to note we cannot see tax returns. As soon as there's tax returns in the file, makes it full doc, right? So just make sure that when you're doing that, just provide the W-2, and we can always just pull W-2 only transcripts if we need to.
Awesome. Thank you. And then John did have a question. Where would you put the P&L or verbal VOE type programs I have seen? So John, I just want to make sure, does that answer your question? I'll hop to the other 2, but you can use the chat and let me know if that covers what you needed. If not, go ahead and just let us know and we'll make sure that we get you the right answer.
Absolutely.
Next question, is it better to use 12 or 24-month statements?
It's a little bit of a trick question. Obviously, the more documentation and the more support you have for the income, just like with conventional files and the like, it's less risk for the investor, right? So the longer period of time we look at, the better pricing we can offer you because it's the better pricing that the investor is willing to offer. So in short, if you give us 24 months, you're going to have better pricing. Is it a significant amount or difference? Not terribly. A lot of times it also depends. If the income is declining, we're going to use the most recent 12 anyway for your income calculation. But if it's inclining, maybe it's better to only provide us the 12 instead of averaging over 24. So it just kind of depends on what your particular scenario needs and maybe the price sensitivity of your borrower.
Awesome. And then another fun one, especially based on my underwriting background, is it common to provide conditions that generate an additional condition?
Absolutely, yeah. So just like if you were, providing, a bank statement or something for sourcing assets, right? This is a very common one. A lot of times we'll see a large deposit and we have to source it, right? That's a perfect example where the same thing could be true here within, the non-QM space. Sometimes you provide something and it generates an additional question based off of, what we're seeing now, right? So yes, absolutely, it can be common. I wouldn't say it's on every file, but it's definitely something to be aware of. Again, not unlike we go to provide assets for closing costs, et cetera, and then we have to source a large deposit. The same exact thing can be true and happen within this non-QM space as well.
Totally. Thank you. And then John did further clarify. So he says, I have seen a P&L or VVOE, so I'm guessing wage earner is what we mean there, type
Yep.
programs, and have not explored what they require to calculate income and how they differ from other non-QM programs.
Yeah, so a lot of those alt doc programs are going to be very similar in terms of the underlying guidelines, right? Like most of your alt doc is going to have options up to a 90% LTV, up to a 50%, 55% DTI, depending on the investor. So there's a lot of different options that you could utilize. We do have the option to use a P&L program. One of the ways I would say that it differs from like a bank statement transaction is you do have to own a greater percentage of the company. So 50% instead of 25 is the floor, right? So if you had someone that owned above 25 but below 50, then you'd probably want to go bank statements because you wouldn't be eligible for the P&L. And then VVOE, that's going to pivot more into the wage earner full doc type of scenario, which we'll get into here in just a little bit of time.
Fantastic. All right, it looks like that's it for the Q&A for this section. Again, feel free to use the chat and then I'll make sure that we get those addressed for you guys.
Yeah, thanks for the questions. We really appreciate it. All right, DSCR, this is a fun one. This is opportunity knocking at the door right here. Investors do more real estate transactions than us common people out here that aren't investing in real estate, right? Because they're doing a lot more transactions, making either acquisitions, maybe a cash out refi to then make more acquisitions, all of those sorts of things. So this is an important part of the market to try to capture here. DSCR, debt service coverage ratio, it's basically just utilizing the income from a cash producing property to offset the new monthly obligation on the property. We have two ways of calculating this. We can either do a fully amortized or an interest only. So if we're going fully amortized, it's gross rental income divided by the new PITIA, payment, interest, taxes, insurance, and association dues, for those that maybe didn't get that A on there. And then interest only, again, same thing. The only difference is we're using the interest only payment, so no principal counted. So it's gross rental income divided by the ITIA. Simple way to think about this is if you had $1,000 a month in gross rental income and your new monthly PITIA was $1,000, that right there is a 1-to-1 ratio. Now, if you did have one that maybe had a negative cash flow, we have options for that. We can go down to what we like to refer to as a low ratio loan, which is a 0.75. You could have $750 in gross rental income and $1,000 in new monthly PITIA or ITIA if you're going interest only. In those instances, you could have that negative cash flow and we could still do that loan. Obviously, there's some different parameters and things that you'd have to, kind of circumvent or jump over in terms of FICO score, LTV requirements, but we can do a low ratio loan if you had that negative cash flow in a property. So there's no DTI ratio calculated on these. So your other, debts, income, all of that, doesn't matter. We're still going to capture the debts, obviously, because you're going to reissue the credit report into the system. We're going to see it, but you leave the income fields at 0. Again, there's no DTI ratio calculated. So those other debts and obligations really just help us tie together the kind of full credit profile for the borrower to make sure that they're paying on time, all of those sorts of things. In addition to if they have other REO that is owned, whether it's other investment properties or maybe a primary, that kind of helps us paint that picture that they do have experience within the space, because we do allow for first-time investors, but we do want to see some real estate experience. So important note here, cannot be a first-time home buyer. So you could be a first-time investor, but we do not want to see a first-time home buyer. Quick note here, DSCR is directly impacted by the loan amount, right? So the higher your loan amount, the more you're borrowing, the more that PITIA goes up. So just keep that in mind that they are directly correlated when you're doing that ratio, because again, the higher the loan amount, the more you're borrowing, the higher your PITIA goes up, and that is directly correlated to gross rental income divided by PITIA. Prepay penalties do apply on these loans. I'm sure some people on the call are in a no prepay state. We do have options to 0, so no prepayment penalty for those of you in no prepayment penalty states. In other states where prepayment penalties are eligible, we have options from 0 to 5 years. So you can still elect no prepay. Obviously, pricing is going to be a little bit worse, or you could elect all the way out to 5 years and your pricing would improve. If for some reason that borrower was to pay off greater than 20% of the original unpaid balance of the loan within that prepay period, so let's just say in this instance, 3 years, if that's the prepay penalty that they elected, if they were to pay off greater than 20% or completely refinance and pay off the full boat, obviously, because that's greater than 20%, then they would be subject to a prepayment penalty. The prepayment penalties here at Sierra are 6 months of interest due if they pay off, again, greater than that 20%, or the full boat if they were to do a refinance transaction. The easy way to calculate that is to take your parameters of your loan, go to amortization calculator in Google. The first link that'll show up is a little calculator icon. It'll say amortization calculator next to it. Go ahead and type in your loan parameters, your loan amount, interest rate, amortization. Hit calculate. It'll spit out your entire amortization schedule over the life of that loan, depending on the term you elected. Look at the first 6 months of interest-only payments. That's your worst case scenario. Add that total up. That would be your very worst case scenario. I know a lot of times investors just want to see what that worst case is. A lot of times they'll build it into their hard costs up front. Maybe ask for some seller concessions or something like that if they expect that there is a possibility that they may pay off within that prepay period. An important note here, borrowers can cede the conforming finance property restrictions. So 10 on any conforming loan. We have options up to an unlimited number of properties depending on investor. So some of ours cap at 20. One of ours has up to an unlimited number. An important note here with Sierra Pacific that's different than a lot of other lenders. We do not have a maximum exposure limit. What that means is that the number of loans that you have with us, either in terms of units or in dollar amount, has no cap. So a lot of other lenders out there will say, oh, you can do 3 loans or $2 million or 5 loans or $4 million. We don't have those caps here because we have so many different investors that we work with. We have lots of different options in which to securitize those loans. So we don't have a cap for you. So if you have one borrower that wants to come in with 5, 6, 10 loans and do all of those, maybe some cash out refis to go make some additional real estate acquisitions, we could absolutely do that all here in one spot. Most importantly, it gives you a consistent output and expectation of the quality that you're going to get on each of those transactions. And more importantly, it gives the borrower the consistency, right? So they don't have a bunch of different lenders that are doing things in slightly different ways, different emails. It's all the same. It'll be the same look and feel every time. So they have that consistent repetition of, oh, this is the exact same thing I did on the last one I did. And again, first-time investors are permitted, but not first-time home buyers. We do have additional restrictions like a 75% cap on LTV, those sorts of things. And there'll be additional FICO requirements and typically a DSCR ratio requirement as well. We're typically looking for a 1-to-1, but first-time investors are permitted as long as they are not a first-time home buyer. This graphic is really important. This is, again, opportunity knocking at your door. Every state in light blue here on this graphic is a state where you can conduct business as an LO without being licensed on a DSCR loan. The 7 states, that's 43, right? 43 states that you can do a DSCR loan with no licensing because they're considered business purpose or kind of commercial light, if you will. The other 7 states, I will tell you, there's 2 additional states we're working on. Tech always drives compliance with all of us lenders nowadays. So we're looking at opening up Georgia and Florida at a later date. So stay tuned. We'll make sure to update you and send out some bulletins once those are opened up. At that point, you'd have 45 states where you could do this DSCR business with no licensing. Again, it's considered business purpose lending or kind of commercial light. Another important factor here is you can close in the name of an LLC or an entity, and we do allow up to 2 layers of entity ownership within that. All right, now we've got our FAQ section.
Now, Will, I do have some really good questions for you from the chat. Thank you,
Outstanding. Love it.
everybody, for participating. You're all keeping me
Yes,
on my toes today.
we love it.
We do have a question, a good one to share with everyone from Sean. And he said, is a first-time investor required to own a home? If so, do they need like a verification, or excuse me, if not, do they need like a VOR for that, for their residence? Like how do we address that first-time investor?
Yeah, absolutely. So we do allow for first-time investors, again, not first-time home buyers. So typically what we want to see is them owning a home, primary or otherwise. Obviously, if they own an investment property, they're not a first-time investor, but we do want to see that home ownership for the most recent 12 months. And we would want to see, obviously the consistency of payments and all of those sorts of things. So cannot be a first-time home buyer, but can be a first-time investor if they, currently own a primary.
All right. And then he also had another great question. If they owned in the last 3 years, sold the home, say maybe 2.5 years ago, and they don't currently own, can we utilize that for DSCR?
So non-QM is based on exceptions. So what I would say is if they have a good credit profile, they have, depending on their LTV, because on a DSCR loan, there's really only 4 items that are kind of compensating factors, if you will, for exceptions to be approved, right? It's LTV, it's FICO and credit history, it's reserves, and DSCR ratio. So if they're a first-time investor, but all 4 of those things look really good, right? Like maybe it's a 50% LTV, and they have good reserves and a strong FICO. Yeah, that's probably an easy one where we could, kind of circumvent that guideline and get an exception for you. What I would suggest in that instance is reach out to your account executive. Let's talk about the scenario. They can get me involved at any point in time. I'm not hidden behind a curtain or anything. So, let's talk about the scenario. Let's talk through those compensating factors, and let's seek an exception if it makes sense, right? This is all common sense lending, what we're doing here. So there's always a possibility to do something that maybe just doesn't, have a direct line or path forward within the guidelines.
Beautiful. And then just a quick note, I responded back to Margot, but she did ask the question, how do you find and connect with investors? Why would they be in the market for a new loan officer for their DSCR loans? So this was something that Will had covered in our first call within this series, and it's fantastic. So he literally goes through, maybe we're going to reach out to CPAs and all these different types of people who actually truly need us as much as we need them. So hopefully we can send out that first link. Marketing did drop that link in the chat. And then I'm thinking once we send this out, we'll include the first and then this new second recording. So you guys will have access to that deck and that call because it was fantastic.
We're going to reference that again. You beat me to the punch on that one, Suzanne. So good job there.
Good deal.
We're going to reference that first training as well towards the end here, and kind of just remind everyone that attended the first one, or give kind of a heads up to those that didn't make the first one, who those 14 best contacts are in terms of your marketing efforts to capture some of this non-QM business. And then we'll drop that link in the chat again, when we get to that slide, just to kind of keep it top of mind while we're talking about it.
Perfect.
And I did see a question pop in the chat. while you were, answering that. So I'll go ahead and address it real quick if you don't mind. So I did see a question pop in as to since if you close in the name of an entity, does it show up on their CBI or their credit report? Yes, we do require personal guarantor for any entity owner to be on the loan, up to 4. So anyone that is a part of the entity would also need to be on the loan, and they would, sign an addendum or an affidavit saying that they are a personal guarantor. So these will be reporting on their personal credit reports or CBIs as you reference them. And then just to kind of elaborate a little bit more, we do allow, as the final question here in the FAQ section, for the closing of an entity, and we offer 2 layers. So a perfect real world example here is my sister, actually. She owns an S corp, and then underneath her S corp, she keeps all of her homes split up into 2 or 3 homes in a series LLCs, right? So she's got like a 2022 acquisition series LLC, 2025, going back several years. I won't say how many because then you might tell how old she is. But in all those acquisitions that she's made, she's kind of bifurcated those out into series LLCs. And then all of those series LLCs are owned by the S corp. The S corp is owned by her. That's a perfect example of 2 layers of entity ownership, where individual owns entity 1, entity 1 owns entity 2, and then that's the one that's going to be vested on title for the acquisition of that property or the vesting of that property.
Beautiful. And then I do have 2 quick pricing questions. So John had asked, does the time left on the prepayment affect the amount of the penalty? So for example, would prepay be the same if 1-year term was left versus a 2-year term, for example?
Yeah. So in my example earlier, I gave you kind of the worst case scenario, right? Just looking at the first 6 months of interest payments. Typically, it's done based off of the amortization schedule, right? So if you only had, let's just say, 6 months left on your prepayment, you're typically looking at that 6 months of interest that would be due. So yes, but it's a diminishing amount typically in the first, 3 years of the payment. So if it were me and I was talking to my borrowers out there in the space in your shoes, I would just say, look, here's your very worst case scenario. Typically, that's enough for them. It does diminish, as you get further into the amortization. So, like if you elected a 5-year prepay as a borrower, it will kind of diminish a little bit, but it's a fairly inconsequential amount. I would just give them that worst case for that first 6 months, and then they kind of know from there.
Perfect. And then Denise, she's not able to pull up pricing with a prepay, so it could be state specific. So that's
Yes.
something that we can take a look into. So I'll take that on the side and review that for you, and then we'll reach back out.
Yep. There's a number of states out there, and look, there's several other states that have very complex prepaid penalty guidance. That our system currently doesn't capture. We're working on adding that. So at a later date. But in those instances, it might be a state where they just have a very complex, series of prepay requirements that every lender kind of has to jump through. So in those states, it may be that that particular investor just said, "Hey, we're not going to offer one there." So there are some instances where you may see that, even if you are a prepay eligible state. So just kind of keep that in mind.
Beautiful. All right, and then I'll get to these wonderful frequently asked questions. So what if a property doesn't cash flow on a 1-to-1 ratio? Do we have options?
As we referenced on the previous slides, yes, absolutely. We have low ratio options down to a 0.75. So you could have a property that has negative cash flow, and we could still do that transaction.
Perfect. And another thing that we had covered a few times now, do we allow for first-time investors?
Absolutely. First-time investors good to go. No first-time home buyers.
Beautiful. If we have an investor that wants to refinance or purchase numerous properties, would this be permitted? Is there a limit with SPMC?
Absolutely. So no restriction or limitation on maximum exposure with us. So yeah, bring them on. We got them.
Yes,
We'll do it.
which is huge. That's one of my favorites.
Yep.
And then can we close in the name of an entity?
Absolutely. Again, 2 layers of entity ownership. It could be a single, right? Could be owner owns a company. Company's going to vest on title for that, individual property. Yeah, no problem.
Awesome. All
Cool.
right, good stuff, guys. Thank you.
Thanks, Suzanne. All right, let's jump into full dock and wage earner. This is what I like to refer to as your safety net on your conventional and govy transactions, right? So this is where, maybe you have something that fell out through, or had some sort of restriction within the guidelines that we had to pivot over and do, a full dock or wage earner through non-QM because of some form of, extenuating circumstances. And we'll kind of go into that here in a moment. So we're really looking at 1 or 2 years, most recent 1040s for those self-employed borrowers, signed and dated year-to-date P&L, obviously to just make sure they're still in, that line of work or business, and that they still have, cash flow and money coming in. We will have an executed 4506T obtained for each borrower and their 1040 transcripts. 2 years self-employment history, but if you have compensating factors, we could do 1 year. So let's just say, maybe it was, a dentist, right, that was going to school for many, many years, and now they've pivoted over, they've completed school, and they've started and opened up their own shop. It's been in existence for 13, 14 months, over 12 months. That's a perfect scenario where we could do a transaction for that borrower because the education kind of, supplements as additional time as self-employed. Wage earner, we're looking at, written VOE or VVOE, verifying 2 years of employment, kind of alluding back to the question we had in the FAQ section earlier. Most recent pay stubs reflecting 30 days and year-to-date earnings. And then, 1 or 2 years W-2s as well. And then executed 4506T for each borrower. W-2 or 1040 transcripts are acceptable on this because it's wage earner. So lots of different options here in order to kind of obtain or use that full doc income without having to go through traditional means. We do allow for variable overtime, bonus, commission income, all of those sorts of things. 1 or 2 year documentation type, written VOE required to show breakdown of income. We want to see what was hourly, what was salary, what was bonus, commission, etc. Variable income for less than 1 year cannot be used. So just keep that in mind. We do have to see still on variable income that 2 years consistency of receipt. And then, obviously it's average 2 years plus year to date or 1 year plus year to date. If most recent 12 months is lower, then obviously you'll use the shorter time frame, not unlike a conventional file. So we'll move on to the FAQ section. Suzanne?
Yes, so love this too. Why would we go non-QM full doc instead of just going QM?
That's the question of the hour on these products, right? So why would you use it, right? So great examples here. These are all manual underwrites through non-QM, right? We're underwriting these directly off the investor guides. So no findings apply. So if you had an ineligible refer finding, maybe it was due to a high DTI, or maybe it was some sort of a property ineligibility, like a non-warrantable condo. Maybe it was a second home or a 2 to 4 unit property. Maybe it's an investment property that they can only put 15% down on. That's another great opportunity here because you can go up to 85% LTV with some of our guidelines. So there's a lot of different ways that we can kind of pivot into these that, kind of gets away from the alt doc, but lets us circumvent those guidelines that we would see, utilizing, conventional or conforming or govy guidelines. We can also exceed the max number of finance properties. So instead of the limitation of 10 through conventional guides, we have up to an unlimited number of properties on certain investors. Others are often offering up to 20 finance properties. So still a lot. And then allowing for 1 year self-employed income when your findings dictate that 2 years are required. We could do 1. Again, we still need that history of 2 years in the same line of work, or 2 years or 1 year with the compensating factors as we discussed, like education and things. And then also we can avoid acreage caps or certain zoning restrictions, like FHA only allows you to use value of the first 10 acres. Well, we have product options going up to 20 acres, and we can do rural properties. So in that instance, it might be better to utilize one of these full doc scenarios or product enhancements where we could actually use the full value of the property. Now, you're not going to get your 96.5% that you would through FHA, but you could utilize the full, full value and possibility of the property there. Any
Beautiful. And then
questions?
we do have another really great question for John. John's keeping me on my toes. Any loan
Thanks, Jen.
programs for condos that are like ski towns that do short-term rental or nightly rentals? And so some of these are actually categorized as a co-op property type.
Yeah, so no current options for co-op specifically. If you do have, those short-term rentals, we do have some product enhancements for short-term rentals. I will give you the heads up in the warning though. We had one of our investors kind of pull out of short-term rentals. So currently, with our current enhancements, until we add another option there, we are going to default to the lower of the 1007 rents noted, or that AirDNA rentalizer or similar showing short-term rents. So what I would suggest in that situation or circumstance is, if you can find an appraiser that can do short-term rent schedule on the 1007 or 1025 appraisal for a multi-unit, then hey, we might have a chance to get that one through and execute on it utilizing short-term rents. So it's possible, but just kind of depends on what we can accomplish and what we can get out of that appraiser. And if you have one of those scenarios, especially, getting more into specificity on it, definitely reach out to your account executive. If they need to bring me in, they can. Let's talk about it more and make sure that we're capturing all of those data points so we can tell you what's probable or improbable, what might need an exception, or what will just fly through seamlessly.
Perfect. We got another one that just snuck in. Are there any restrictions on property condition with any of these non-QM options?
Absolutely. So just like, any of the kind of, agencies that back these, government, loan programs, whether it's FHA via USDA or Fannie Freddie, right? We still have investors on the back end that are, kind of standing up these products and offering these to us. So they're going to want a property that is in, reasonable or good condition, right? We don't want any of your C5 or C6s, or, something that's got a roof hanging off the side from, obsolescence and those sorts of things. So yeah, we still do want to see a habitable, quality property, but the guidelines aren't necessarily as strict as you might see through FHA or something similar, right? If it's just like some appliances that it doesn't have a fridge or a dishwasher or something like that, it's not going to affect its habitability or something. We can move forward on that transaction, no problem.
Cool. Yep, so health and safety still matters, collateral, still want to make sure it's
Absolutely.
sellable. So yeah, keep that in mind. But if you do have any ones that you feel like you're walking a fine line, please don't hesitate to reach out to your AE and we'd be happy to take a look at it.
Yeah, absolutely. Sellability, marketability, those are kind of your two distinguishing factors there. Because look, as an investor, if for some reason someone doesn't perform, and this is why LTV is usually number one on compensating factors, right? For any investor and any lender out there. So the reason that that's so prominent is because if for some reason the borrower didn't perform, and God forbid we had to perform a foreclosure or short sale, the way that those investors, whether it's a government-backed agency or these individual investors like hedges or something similar, the way that they're going to recoup or mitigate some of that loss is by liquidating the property inevitably. It's the same here as it is there. So in those instances, we obviously the less we lend on the property, the more secure that asset is. That's why there are LTV restrictions and those sorts of things on properties.
Beautiful. Thanks, Will.
Absolutely. All right, let's move to 1099s. This is a big one. 1 in 5 employees in the nation right now are going for some sort of gig, whether it's their primary or a supplemental source of income. 20% of the market. That's huge. There's a projection out there that 86.5 million gig workers will be in the marketplace by 2026, or excuse me, 2027. There's a huge spike coming in the spring timeframe of 2026. Got my dates right that time. Kind of in the April to June timeframe. So there is a significant spike coming in the most common or average borrower age, where someone would go out and look to make an acquisition of their primary residence. So make sure you're cued in on this. If you're not already marketing for these types of borrowers, you should be. Make sure you're hitting these, because it's going to become significantly more prominent there's already a third of companies out there using some sort of freelancer or contractor, within their company. So make sure you're paying attention to this. Make sure you're marketing it. Make sure you're ready to capture this business, because it's only going to go up from here. Borrowers must provide 1 or 2 years of 1099s. It's a default 10% expense factor. So again, if they earn money through a 1099, focus on this product because it's a lower expense factor than your bank statements, right? The floor on that was 10% on certain products, but that's with a CPA prepared P&L. Here it's 10% with no P&L. That's just, you're getting 90% right out of the gate. So it doesn't matter what they write off on their tax returns, how much they depreciate from their other assets, any of those sorts of things that they do on their tax returns to mitigate their tax obligation. You're just getting 90% of that income gross right out of the gate. So perfect enhancement for these. We do require 3 months of bank statements or a recent pay stub if they receive a pay stub. A lot of 1099, or contract workers don't. So in those instances, we want to see the 3 most recent bank statements just to confirm that they're still in the line of work, they're still receiving that income, and that it's consistent with, kind of what they've been earning, right? Just to, again, kind of shore it up, make sure that they're still in that line of work. There is a possibility to utilize more than one 1099. It's less common. Typically, people, kind of have one job that they work and that's it. But there are instances, I give this example often, where, a police officer might do some moonlighting where they do some security detail, maybe in a bar or nightclub, uniformed or ununiformed. They may also do like a security detail for like a dignitary or a politician. For those instances, maybe they have multiple 1099s. As long as it's commonplace in their industry, we're good to go. There's also an enhancement here that I want to mention for a lot of other lenders out there. They'll tell you cannot combine W-2 and 1099 income for the same borrower. We actually have the ability to do that here, but it has to be commonplace in the industry. Again, utilizing that same example of the police officer doing security detail and that sort of thing, that's very commonplace in the LEO world. So for that type of a borrower where it's commonplace in their industry, we could combine, their departmental W-2 income along with their 1099 income, where they're, doing those security details or those sorts of things. Another good one here, real world example, is firefighters. Here in Texas, where I live, a lot of firefighters will do, lawn care in the summer on their off hours, and they'll hang Christmas lights in the winter. Again, that's commonplace in their industry. If we can kind of draw that correlation together, then we could still combine that income for them, again, as long as it's commonplace in their industry. We do require the business narrative on this. This is, kind of like another self-employed. We just want to know how they earn their money, the consistency of that income, if they have any other employees or obligations associated to that. That business narrative can also help us completely mitigate the expense factor. If for some reason we see notation on that business narrative that, hey, they're getting, per diem. Like I know a bunch of guys from way back, 20 plus years ago that are still doing welding, today, and they get per diem for hotel rooms, gas, food costs, those sorts of things. When they go out and they do these, 1099 contracts, in those instances, if we can prove or we show that, hey, they're getting that per diem, so they don't have any additional expenses, we could completely erase the default expense factor of 10%, which means they would get 100% of the income that's shown on their 1099s. Again, not accounting for any, tax obligations, their write-offs, any of that other, stuff that's on there. On their tax returns, we could completely mitigate all of that and give them, 100% of their income potentially. And then again, income can be supplemented on this product. You could use W-2 from a co-borrower. You could use alimony, child support, trust income, royalties, all of those sorts of things. We can combine that for this, type of borrower situation as well. We could also combine bank statements and 1099. If you had, one contract worker and one self-employed borrower, we could combine those as well on the same, transactions and loans. So lots of different ways here to kind of layer income. And again, this is only going to become more prominent as we move further and get closer to that springtime spike that we're seeing in the average borrower age in spring of 2026. And again, 86.5 million projected to be in the marketplace doing this type of work by 2027. This is going to be huge, guys. All right, Suzanne, I'm ready for some more questions. Let's do this.
Sorry, I couldn't get off of my mute button. Right. So is it better to use bank statements or 1099s?
Trick question. Depends on how they earn their money, right? So obviously, if they're earning through 1099s, you're going to have a lower default expense factor. In addition to, you could completely eliminate the expense factor with that business narrative or maybe some additional documentation if it was needed. So if they earn through 1099s, I would strongly take a look at utilizing the 1099 program. If for some reason they don't earn 1099s and it's just truly self-employed, everything's going into directly into their bank statements. I would use, the bank statement program for those self-employed borrowers that don't earn a 1099.
Perfect. And then why would we use 1099s instead of tax returns? Besides, we
Just
hate tax returns and never want to see them.
that's the perfect example right there. Well, because on tax returns it shows write-offs, it shows depreciation on other assets, all of those sorts of things that lower the tax because they have a good CPA, right? And they're trying to lower their annual tax obligation. But what that also does is lower their net income that we could use to qualify. But if they use the 1099s, we could use the gross of the income, maybe with a 10% expense factor, but you could potentially mitigate that completely as well. So just
Beautiful.
more income.
And then I will take Ron's question. Going back to DSCR, how about unique properties? So like little homes, log cabins. So when it comes to collateral, we need to make sure that it meets, we're going to be able to meet all of our marketing requirements. So you would have to be able to comp it out. Is it typical for the area? All of those factors would still come into play. And again, if you've got kind of a weird one and you're not sure whether or not it would work, please don't hesitate to reach out and we can at least take a look into it for you. But just make sure we're meeting marketability, saleability, health and safety. So all of those kind of typical things you want with collateral.
And I would say I would stay away from tiny homes.
Yeah.
They're a lot of times those are considered chattel or personal property, not unlike a mobile home that hasn't been affixed to the property. For those same reasons, there's no, mobile or manufactured homes within the non-QM space because there are zero investors that have any appetite in it for the most part. Again, it's going to be the same thing for those tiny homes, even log homes. In a lot of cases, a lot of investors just don't have any appetite for it, and a lot of that is driven based on the non-performance of those loans historically.
So you're saying I can't do this for my treehouse?
Yeah, you cannot get your treehouse, Suzanne. Sorry.
Dang it. All right. Maybe next year. We'll keep trying, guys.
Yeah. All right, let's talk about asset depletion. Again, this is going to be used as standalone or supplemental source of income. Could be, a borrower that has, kind of reached the twilight years or, kind of finished up in the workspace, or it could be someone that, has a bunch of assets still in the workspace, earning good money, but they need just a little extra to kind of push it across, that finish line and supplement their income. Great way to do this is asset depletion. So we can use assets from a variety of sources. And when you see here kind of in the center, the 100%, 80%, 70%, what I want you to think of here and kind of remember in the back of your head, in one of those way distant back file cabinets that you've got back there is it's really just directly correlated to a tax obligation or with early withdrawal penalty, right? So obviously checking, savings, money market savings, bonds, CDs, they don't have any tax obligations associated. They don't have any early withdrawal penalties associated. So you're going to get 100% of those funds. If it's stock, mutual fund, bond, they're going to potentially have tax obligations. You get 80% of those. Retirement accounts or assets for borrowers under 59 and a half. Obviously, IRAs, 401ks, self-employed retirement accounts, they're going to have potentially both tax obligations and early withdrawal penalties associated. So you'd have a 70% haircut on those. Assets here are depleted over only a 60-month period. So, using the, numbers above, if it was in a savings account, you had $1 million, you're going to get 100% of those assets. You divide that over 60 months, you break that down. There you go. There's your monthly income that you could either supplement or use as standalone. If you had, something in a stock, mutual fund, or a bond, you'd get 80% of that. So 800,000, divide that over your 60-month period. There's your monthly income that you could use as a supplemental or standalone source. Just note, we do require 3 months of asset verification in the form of statements. What we're really talking about here is if it's something like a checking or savings that generates a monthly statement, we want to see 3 consecutive months. If it's something like a retirement account, maybe a stock or a bond fund that only generates a quarterly statement, just that quarterly statement alone is enough. We really just want to see a 3-month look back period to see the consistency of those assets being in the account and being available. That's really what we're talking about here. We'll jump into some more FAQ.
Can we combine asset depletion with other sources of income?
Absolutely. As we've already talked about, kind of across, all of these different products, other than DSCR, because, no income needed there. But across all these other products, yeah, we can supplement asset depletion with the others. We can, utilize it as standalone. We can also, use child support, alimony, royalties, trust disbursements, all of those sorts of things. We can combine all of that together, or retirement, et cetera, with these different product enhancements. All of those options are available.
Sweet. That actually saved a loan a few weeks ago, so that was fantastic to know.
Yep.
If I have 2 separate accounts, like a checking and a savings, could I use one can I use one for bank statement, other for the asset depletion?
Yes, absolutely. So what we don't want to see is using the same account twice, because then we're counting that money twice. So what we wouldn't do is use business bank statement and then use that same account to then deplete the assets that are in there. We've already counted it once on the income for all of those eligible deposits coming in. We wouldn't then count it again for asset depletion. But if you have funds that were transferred over or put into a different account, and you had that business income coming into those business bank statements, then we could use that other account for the asset depletion, use this for the eligible deposits. We could do that. Yep.
Perfect. So no double dipping, just to note.
Yep,
And then
exactly.
Sean just wanted to reaffirm, so do not need to be 59 and a half, so if you go to the previous slide, if bank
Yeah,
or stocks.
that's correct.
So just that whole early withdrawal penalty
Yes.
that you see a lot with conventional QM.
Yep, that's what the 70% haircut is for. So if you were below 59 and a half, then you would have that 70% haircut apply for early withdrawal and tax obligation. But if you're 59 and a half or older, then you wouldn't necessarily have that 70% or 30% haircut.
Perfect. All right, that's it for questions for right now. Thank you.
Thank you. All right, so this is again alluding back to the previous iteration or presentation that we did of this non-QM mastery series. These are your best referral partners. I'd strongly encourage you to go ahead and take a quick snapshot. I believe marketing just dropped a link in the chat as well, so you could follow that link back to our company YouTube channel and listen to and glean some information from that first presentation. If you aren't talking to these 14 contacts already, you are missing your opportunity. These are some of your best referral partners. They're going to bring you some complicated and complex scenarios, but that's what we're here for, is to support you and talk through those. And the best part about these individuals is they need the information that you have because they don't know it, right? The other thing that's important about these individuals is I've been a realtor in Texas for almost 15 years now. I do maybe 1 or 2 transactions a year. I am not the guy that a lot of these, LOs want to be marketing to, but I am blown up every day. Phone calls, emails, text messages, people trying to capture my business that I don't really, do a lot of. Mostly just, friends and family type stuff. But I'm still pressured constantly by all of these different LOs trying to capture my business that, is fairly non-existent, frankly. These individuals are not pressured in the same way as your realtor partners. They will be less resistant to the information that you have to share. We regularly have a call, my wife and I, with our financial planner. And typically the last 5 to 10 minutes of every call that we have each quarter, as we kind of go over our portfolio, she just kind of picks my brain about what I'm seeing in the mortgage space. So these individuals are just going off of what they know and what they understand, and that's what they tell their clients. So if you're not in front of them sharing this information about what we can do in the mortgage space now, they won't know, which means they can't send you a referral because they're just going to say, I don't think you qualify for a conventional based off of what I'm seeing, right? Which they can do because they're not in the lending space. We can't say that until we actually look at things. So if you're not in front of them sharing this knowledge and information, we're missing out on opportunity here, guys. Make sure you are penetrating each of these 14 accounts. If you watched the video the first time, go back and rewatch it. If you haven't watched it, go back and take a look at it. I strongly encourage you to reach out to each of these 14 contact types. It will change your business, period. All right, this is a quick snapshot here of what makes Sierra Pacific stand out in non-QM. So we've already talked about it, blending and supplementing income, no maximum exposure on the, both number of finance properties or, single loans, or loans for a single borrower or entity. DSCR for first-time investors, not first-time home buyers. DSCR using interest-only payments, right? That can help push your ratio to that 1-to-1 for better pricing and those sorts of things. Cryptocurrency is eligible for assets. That's a big one. It does have to be converted into a U.S. depository institution, into U.S. dollars, but we can track that or source that back to your blockchain or crypto wallet, whatever you had that in previously. Non-warrantable condos, again, pivoting, utilizing that full doc or even our alt doc, enhancements. Non-warrantable condos are big that can help you recapture those conventional or govy fallouts. Asset depletion over 60 months, that's a big one. You're looking at only 5 years. A lot of other lenders are out there are doing 72, 84, 96 months. And then the last two kind of go hand in hand. A lot of other lenders out there will tell you, oh, we'll do 15, 20, 25, 30 acres. But then they'll also tell you immediately after that, well, we won't do rural properties. Well, we were smart enough, we have both, right? So not only can you do a 20-acre property, but it could be rural as well. There's additional caveats and guidelines within that, LTV restrictions and the like, but we do have the potential and the possibility to do that. All right, Suzanne, any additional questions that you got for me?
I think we actually covered all of them.
Perfect.
If you guys have any others, feel free to toss them in the chat.
Yep.
And then while we wait for those, I can just introduce John.
Yep, absolutely.
All right, so I'm gonna loop John in. So John, the best McCash, any words of wisdom or any closing remarks from you?
Well, you're asking me to follow two amazing individuals that know a lot more about non-QM than I ever will. So thank you for the amazing presentation today. I learned something every time, Suzanne, I hear you and Will provide information on non-QM. So it's been a remarkable learning session for all of us and appreciate all the content. And look, I want to thank everybody on the call here today just for investing your time and your future. Learning about non-QM is really investing in your future because non-QM is here to stay, right? Non-QM is not going anywhere. It's making up a larger part of the mortgage market today. And I'll share just two quick numbers with the group here. Number one, as Will mentioned earlier, the gig economy, which we would use for 1099 borrowers, is 36% of the population today, people who are in the gig economy, 36%. And so the other item is around DSCR. 1 in every 5 homes closed today is an investment property. So these loans are out there. Your realtors, your referral partners are doing these loans each and every day. And it's a matter of just asking the question and helping educate them on the options that exist today. So again, there's just a couple of takeaways I would just recap for the group on the call today, or some pieces of advice from us here at Sierra Pacific. Remember, you have options. And our goal here for you is to give you more reasons to say yes, whether it's an asset depletion loan, a full doc loan, a 1099, a P&L. The more ways you can say yes, the better you're going to be in terms of serving those referral partners and building that out on a day in and day out basis. The second item is referrals are critical to your success in non-QM. Will summed it up great. Realtors probably get 20 calls from loan officers each day asking for their business. I'm going to assume a tax preparer doesn't get any, right? And so that is a fantastic avenue and sales funnel for you to build referrals. And just think, if you don't call, somebody else will, right? So be the person who takes action and calls that referral partner and builds that out in your portfolio and your referral base. And then lastly, whether you're new to non-QM, you've been doing non-QM for years, the most critical thing that I would suggest in terms of working through this product set is always pre-flight your scenarios, right? There's a lot of different attributes and options within non-QM. So you always want to pre-flight your scenarios with an investor, whether it's Sierra or whether it's somebody else, right? We want to see you succeed in this space, regardless of who you're working with. And so pre-flight those scenarios with your lender partners, work with account executives who can provide you that insight, work with people like Will Davis who can help you navigate this landscape. That will help you crack the code here on non-QM and do more of this business. And so lastly, on the screen here, you'll see a QR code. I think I called it a barcode earlier, which probably just dates me a little bit. So on the QR code, our next session is July 9th at 11 a.m. This is going to be another really important session. We're going to deep dive AltDoc even further, which gets into your bank statement loans, your 1099s, and things of that nature to show how they really work and how the income calculations work. So you don't want to miss that session on July 9th. That one's going to be critical for you to learn all about AltDoc. And so again, thank everybody for the time. We appreciate your partnership. We appreciate you staying late here with us as we've gone a full hour, but the content has been amazing. And if you have any questions, please reach out to your account executive, reach out to Sierra Pacific. We will get you to the right individual here that can help. And we look forward to growing your non-QM business together. Thank you, everyone.
Thank you. Have a great day.